Hi, everyone. Welcome and thank you for tuning into this NBI podcast. Today, we're going to talk about trends in real assets. And to do so, I'm joined by Noah Hauser, Head of Infrastructure Investments and Portfolio Manager at Nuveen Asset Management. Noah, welcome.
Thanks for having me. It's great to be here.
Excellent. So there's many trends we could go through and discuss today, but I guess the infrastructure and the AI demand and all of that is on everyone's lips. So, how do you see infrastructure being a fundamental in that play, especially in terms of surging demand for power?
Yeah, I think you really hit on one of the most exciting opportunities with an infrastructure. I mean, for someone that spent going on 20 years in this space, I've never seen anything like this. And the way what gives me comfort ultimately around what's going on and about gives me further conviction in the overall asset class is when you look at NVIDIA, they're going to need to sell an enormous amount of chips in order to justify their valuation. We're going to build a tremendous amount of data centers across North America and the globe. If we're going to build all these data centers, they run 24 hours a day, 7 days a week. We're going to need to build a lot of power plants in order to ensure that there's a way for these new facilities to run. And so, well, obviously, renewables, wind, solar, batteries are going to continue to have a very important role in this. I think there's a growing acceptance and understanding really across the spectrum that the scale of this opportunity is such that it really is going to need to be an all above the board approach in order to solving for the new supply that's going to be needed. And so we're able to invest in the data centers. We're able to invest in the companies that are building these power plants. We're able to invest in the companies that are handling the transmission and distribution of the energy that's needed for these new facilities. If we're going to build a lot of gas plants, we're going to need gas pipelines. So we're able to invest in the pipelines as well and really highlight in this portfolio for MBI the parts of this food chain that we see the best risk-adjusted returns and have the greatest opportunity for growth going forward.
Yeah, you mentioned gas, so I guess time to market is important in all of this. So solar panels and stuff like that, or even hydro plant is not part of the equation, and especially not maybe a nuclear plant. So you think more gas facilities will have to be put forth to answer this enormous surge in demand?
I'd like to answer that in two parts. I think you're absolutely right. What we're seeing as a differentiator for regions and territories that are winning in this environment are those that are able to site and develop plants more easily than other areas. Like we are starting to see parts of the United States that are clear winners relative to others. So one wouldn't think about it, but Northern Louisiana is becoming a hotbed for new data center development. You wouldn't think of it, but Northern Indiana is becoming a hotbed for data center development. These are areas that, because they're coming from a much lower base, you're able to get enormous torque, leverage. There's going to be an inflection in growth for these companies, and that's something that is really unique, ultimately.
Okay. Anytime we talk about data centers and the hyperscalers and whatnot, it seems that CapEx is just enormous. It's just deep pockets. So do you think that scale matters also in terms of the infrastructures? And how will these companies make money in the short term? It seems, what's the value add in all of that?
I just go back to my original point, which is we're starting to see areas where there are clear winners. And something that I fundamentally believe, and what I'm highlighting within the context of this portfolio, is that winners are going to continue to win. And I say that from the standpoint of, we're going through the process right now of the first wave of spending. And, we most recently got updates on the third quarter calls from all the hyperscalers. These companies have had every opportunity to scale back expectations, to take a pause, to slow their spending. They're doing the exact opposite. Mm-hmm. They are accelerating spending. They're talking about spending more next year. So while there can oftentimes be a lot of it's those that want to throw stones. I think that these companies are not backing off. And what I love about how infrastructure is positioned within the context of this is that I'm really quite agnostic to what the chip is that's powering the center. Like, I don't really care. What's important for my thesis and what gives me conviction in it is, as long as steel is going in the ground, my companies are going to need to build. And that is going to create long-term value in the form of increasing growth rates from an earnings and cash flow standpoint.
If we go back now to the energy problem and some of the sources, we've talked about gas, obviously, and it's something if the energy demand surges to a point where it's bad for the environment, and like we don't want to go back to coal plants and stuff like that. But are there new renewable sources of energy that you see some great potential into, or what's your take?
Yeah,
about
I mean, at this point, and just with how I approach from a philosophical standpoint, investing in infrastructure, by nature, we're going to be investing in a bit more, kind of proven technologies. That being said, and I want to be, clear with this, there are a lot of really exciting things that are going on within the context of small modular reactors, for instance, with nuclear. But these are solutions that are still really quite early on. Ultimately, obviously, like Canada has really been leading within this as well. But it's really an area where I don't see SMRs being meaningful contributors until, at the early part of next decade, call it 2032 to 2035. I think at that point, they could be really important, but there's still that's a bit outside of the horizon at this time frame for us.
Okay, so what about AI altogether? How does infrastructure play a part in all of that, beside perhaps the energy play?
It is going to be incredibly powerful. In fact, it's the most powerful thing I think that's going through the asset class right now. Obviously we've spoken about how this manifests itself in the form of an expanding opportunity set for investment, but really importantly, it's also going to play into affordability. And so if there was one risk that really concerned me, it would be affordability. We're going to invest so much that bills rise too fast and it becomes an inhibitor to more investment. What gives me comfort around that, and what we've done proactively within the context of this portfolio, is really focusing on areas where there is growth and where there is a consistency of regulation. And so when you look at this portfolio, we don't have a lot of exposure to New York, to Illinois, to California. These are all areas that have been subject to kind of more intervention, government overreach. So really trying to focus in those jurisdictions where there's a consistency of regulation and fair treatment. The other thing too that goes hand in hand with that is, as demand grows, ultimately, like, these are companies that it has a very powerful and positive effect from a cost standpoint for the end consumer. You want to be in places where there's more investment, where there's more growth, ultimately, because that allows you to share those costs over a greater denominator, ultimately. And so it has a dampening effect on overall kind of the increase of rates versus what you would otherwise be seeing. And so it really gives me comfort, because we've taken steps to put this portfolio in a position where the companies really are benefiting from this growth in demand that has had really important effects from an affordability standpoint. I'd also say too, we're very much in the early innings of these companies truly implementing AI from a cost standpoint in their own cost structures. Mm-hmm. But the energy and utility infrastructure space is ripe for opportunity there. And ultimately, costs are a pass-through. So to whatever extent that they're able to better manage O&M, operating and management expenses with AI, that's something that's going to accrue very favorably to many of our companies.
So if we go back to our main subject, which is trends in real assets, would you say the weight of data centers and utilities and whatnot has increased tremendously over the past couple of years? How do you play that? How do you diversify your portfolio to take hold of that?
that is absolutely what I've done within this portfolio. We own more utilities now than we have at any point in my career, and that really is a reflection of the secular growth story. What truly is a generational opportunity for investment. Like what we're going through right now is the biggest period of investment since air conditioning. So I'll let that sink in for a second on just how significant this is. This is an enormous deal that we're in the midst of right now, and I would argue still the very early innings of it. And so that's incredibly important and something that makes me very excited. Now, that being said, it's something that also I think plays into the fact that when you look at the markets today, there's enormous skepticism. There's some uncertainty. There's uncertainty around the path of the global economy, and what ultimately is going to happen. That is an environment in which infrastructure can thrive. So I have taken steps to move this portfolio in a direction where it has the resiliency, which is the hallmark of infrastructure and real assets, while still also maintaining positions where there's a greater inflection or visibility on growth going forward versus other opportunities.
Okay, you mentioned a backdrop that's quite positive, and obviously there's a lot of deregulation going on in the U.S., more favorable environment, certainly more pro-growth on the part of the Trump administration. So what are the main risks in your view? Do you see, you mentioned NVIDIA, not to name it again, but elevated multiples everywhere. So what are the risks of this frenzy or fraudy market ending sometime in 2026? What would be the impact on your portfolio?
What you're highlighting right now is one of the many reasons why I find the backdrop for the asset class to be so attractive. I think one of the few things that I can be confident in right now is that valuations are high and that there is a general kind of caution or skittishness on that of investors on the overall market just because of valuations.
Okay.
A hallmark of infrastructure is resiliency. Mm-hmm. It's downside protection. That comes from just the highly contracted, regulated, visible earnings and cash flows that our companies generate. So to the extent that an investor has hesitation around broader market valuations, or can equity markets keep up after a really strong period here, that is when infrastructure can thrive. Because many of our sectors are still quite attractive relative to the market when you look at historical multiples. And so as a result of that, that's what gives me even further conviction and why right now is such an attractive time for infrastructure. Layer into that, we haven't talked about inflation yet, but that's something that, again, with today, that's now back in the news. It's something that's being focused on. Is that going to push out further rate cuts because of concern there? Infrastructure, again, is a great asset class in more inflationary environments, and that comes directly from the sectors that we're investing in. What are great sectors in a more inflationary environment? Pipelines are fantastic. One that's maybe less commonly thought of, waste companies. Incredibly effective at passing on inflationary increases, protecting margins, even expanding margins within that backdrop. So I really do think it's just further argument for why infrastructure can be a full cycle investment, why it should be a full cycle investment, but why I feel like right now is such an attractive time.
Okay, so that's sector-wise, or more sort of use that as a hedge. The AI trade is certainly more U.S. focus. Are there parts of the U.S. that are more relevant in all of that, and even more geographically speaking? Like, is there opportunities outside of the United States?
So the early edge and the greatest opportunity right now is in the United States. This is the value, though, of being with someone with an experienced global manager, is that we all know that things run in cycles. They might start in the United States and then they migrate to Southern Europe. They make their way up. There are patterns to this ultimately. And so while the United States is certainly the area where there's the greatest investment right now, when we speak again, next year and the year after, I think that you're going to continue to see increasing opportunities abroad. It's just right now, much of the focus is on United States.
Okay, so we stick to the U.S. and the backdrop currently. Last FOMC meeting, Powell, he was not too reassuring, saying that a cut in December was not a foregone conclusion, but then the market expects that there's going to be more rate cuts in early in 2026. So how do you see, what's your point of view on that, and how does lower interest rates affect infrastructure or real assets altogether?
In a really positive way, from the standpoint of, because of the nature of the cash flows that our companies generate, very visible, long-term, contracted in nature, falling discount rates is very powerful and very important from an overall value proposition standpoint. So it is absolutely something that would positively influence the valuations of the companies that I'm investing in.
All right. Okay, no, I think that's all the time that we have today. Thank you very much for sharing your thoughts on real assets. Thank you for participating.
Thanks so much for having me. I really appreciate it. Thanks.
All right. And for everyone listening, thank you for tuning into this NBI podcast. And we'll talk again in about 2 weeks' time, I think. Thank you.